In this video, I'm going to be talking about the one specific trading day that you cannot be missing out on anymore. This day only happens 11 times a year. That's right, it doesn't even happen every month. I have not heard any trader speaking about this, and that is why I'm with you today. I'm going to tell you about what this day is and how you can specifically capitalize on it when it does come up. Let's get into it. Here it is, the post-bank holiday. This is personally and statistically, I would say, the most high probable day for a setup to occur on. And I'm going to explain later on the factors of why the post-bank holiday is so good. But before that, I'm going to explain why the bank holiday is so bad. So if you've been on the markets before and you've watched people online, you will have typically seen that bank holidays are absolutely shocking to trade on. That is for many reasons, but the main reasons are bank holidays are low in volume. Here we can see a bank holiday candle is small, a normal trading day is big. Bank holiday candles are small in comparison to non-bank holidays because the banks aren't trading, hence why it's called a bank holiday. Why do the markets move? Why do the markets move? Because people enter and exit the markets. So now that we understand that the markets are propped up on people entering and exiting the markets, and we understand that banks have the most capital to invest in the markets, this just shows every single reason of why we shouldn't be trading on the bank holiday. Okay, so now that we understand why bank holidays are not the best days to trade on, I'm going to explain the difference between a post-bank holiday and a normal trading day, because they are two very different days. Before I do that, I've got one more thing to talk about, and that is sessions. As you can see in the bottom right hand corner of your screen, you'll have a little sessions box here divided up into two, saying electronic trading hours and regular trading hours. Here I've got a graph, a chart, a visual representation of what these two different candles look like. These candles are the same day, but they look different because they are two different candles. Both, let's just give an example of the 15th of September. This is a 15th of September daily candle. This is a 15th of September daily candle. So the ETH, electronic trading hours, is represented by the markets being open 23 hours a day. They open at 6 p.m, they close at 5 p.m. the next day. Then we've got the RTH. The RTH is represented by the bank's opening and closing hours. NASDAQ, as an example, is a American index. That means that when the New York Stock Exchange opens, NASDAQ's regular trading hours candle opens. And when the New York Stock Exchange closes, NASDAQ's RTH candle closes. And this is very important from a 2-day basis. So I hope you understood what the difference between an ETH candle and an RTH candle is, because now I'm going to show you the difference of why this is so important. Here is a chart representing the 6 p.m. open on Monday and the 5 p.m. close on Monday. And here is the 6 p.m. open on Tuesday and the 5 p.m. close on Tuesday. Remember, these are the ETH candles. If we draw out the 6 p.m. open and the 5 p.m. close, that represents Monday's ETH candle. Now we draw out Tuesday's 6 p.m. open and Tuesday's 5 p.m. close. That represents the ETH candle of Tuesday. Now, where does the RTH candle come in? At some point in this 23-hour range, the RTH candle will open. Let's say it opens right here. Let's say that RTH candle opens. So here's the RTH candle opens here, and on the RTH chart, it will look like the candle has opened here and the candle has closed here. So, okay. Now we go to the Tuesday. The Tuesday, 6 p.m. open, 5 p.m. close. But where is the RTH candle open? The RTH candle open, let's say it's right down here. This is where the RTH candle opens. So now that we understand that, what happens when this RTH candle opens? So we already know that on the RTH chart, it looks like the daily high is here and the daily low is here. On the RTH candle, as soon as we open up here, yeah, let's forget the fact that we've closed at 5 p.m. When we open here, look at that. The difference is the candle low for Tuesday is here. The candle high for Monday is here. That is an imbalance in price. Now remember what I was talking about with the ETH candle and the RTH candle being very different. If we remember, the ETH candle opened here on Monday. Now, what this means is there's a bunch of built up trading. There's a built up amount of liquidity here. And there's also a built up amount of liquidity from here. Why is that? That is because the RTH candle opened here and the ETH candle had already opened, leaving all of this liquidity up here. And now the RTH candle on Tuesday has opened and we have all of this shit to chase. If this doesn't make sense, then I'm sorry, but I'm trying to explain this in the best way possible. So if you didn't understand that at all, this next bit you will understand because I'm going to show it on charts in real time. So let's jump to that. Okay, so in this first example, I'm going to be showing you guys the bank holiday from the 18th of February. So as we can look on the right hand side of the screen here, we have the RTH. This represents regular trading hours. On the left hand side of the screen, we've got ETH, electronic trading hours. And if you have listened to what I've been saying, the RTH will have a gap in between where it left off and where it's now beginning, aka the low and the high. But the ETH will have all of this built up price action still on the chart. So how could I have capitalized on this? I go into the morning, I understand we have just got sell side liquidity for ages, and I can premeditate the fact that if we are mumble jumble around the top here, then I can premeditate that we are going to have a sell side imbalance. That is exactly how you capitalize on a move like this. So if you pair it with a strategy like mine, where you have internal manipulation paired with an S&T, and then we break structure in the presumed direction, then it is easy to capitalize on moves like this. Look at all of this sell side liquidity paired with an imbalance. Do you really expect that not to get taken? Like, I can't explain it any better. This is just pure logic, and either you can see it or you can't. So yeah, there's example one. I'm going to show you one more example. Maybe it will be good, maybe it will be bad, but this is the bank holiday that is straight after the February one. And here is example number 2. If you remember, we have the ETH on the left hand side of the screen and we have the RTH on the right hand side of the screen. This is not a good setup. It is blatantly obvious that it is not a good setup. I mean, we've already legged up heavily and we have equal highs resting. So just from an outside perspective, we can kind of tell that this is a massive opening gap. As you can see, this gap is 300 points big. Do we actually expect that to get breached all within one day? Absolutely not. I mean, as I said from the last clip, if everything aligns, and you have a reason to get in and take the trade, then bang, I mean, well done to you. But if price is doing something like this, then you know that you shouldn't even bother. So as we can see here, we have got Asia lows resting, and we probably have a 4 hour for value gap here. So could you take this setup? Yes, you could. But we have also got London highs and London lows resting. What do we want to see if we're bearish on a day? Just in this perspective, we want to see manipulation higher before we go lower. Can we see any manipulation higher before we go lower? No. We instantly take out London low and we reject higher. Bear in mind, we have got Asia low and London high resting. So yes, the opening gap is in line with Asia low, but if we see an instance like this where the rejection is sharp, then we can kind of see that we are going to move to the upside. And as we can see here, we have internal highs stacked absolutely everywhere. So that is a pretty clean day of when this opening gap is not going to work. And let's get into the last and final example. So here is the final example. As you can see here, we've already done the ETH and the RTH. The candle close is Wednesday the 18th and the candle open is Friday the 20th. That's a 2-day gap. What does that mean? We've got 2 days of built up liquidity. Now look, as I said, if everything aligns, and I'm saying this right now, if everything aligns for you to be directionally biased with the opening gap, the bank holiday opening gap, it has a 90% chance of going there. In example number 1, we had a very high likelihood of going there. In example number 2, we had a very small chance of going there. And example number 3 hits the nail on the head and shows you what happens when everything is aligned. We're going to hop in and find the high probability liquidity. So we've got London low, Asia low, and low resistance liquidity paired with manipulation higher, paired with a break of structure on the low time frames. You can't see it better than this. You can see the volatility that gets put in the days with an opening gap from a bank holiday, and you can see what happens when you have a fuck off draw that is clear. So there we have it. That will be the end of the video. I hope you guys have learned and enjoyed this video. If you have, drop a comment down below of what you've learned or what I could do next time to help you more. Peace.